and welcome to Benzinga's very special webinar titled Much Ado About 0DTE's and sponsored by Cboe. Let's roll the intro and we'll get started. Welcome back, folks. I'm Matt Steinmetz. I'm Vice President of Virtual Events here at Benzinga, and I'm so pleased to be kicking off today's event. You are all in for a treat. But before we get our program started, I'd urge everybody to check out upcoming live and virtual events being produced by Benzinga. We do a live webinar every other Thursday right here, and we're so excited to be just 1 week out from two huge in-person events, both in New York City. Benzinga's FinTech Deal Day is Monday, November 13th, and the Future of Digital Assets is Tuesday, November 14th. Again, both in New York City. Limited tickets remain to both events. Be sure you check out those events and all upcoming Benzinga events at benzinga.com/events. All right, over the course of the next hour, we're going to take a critical look at an increasingly popular instrument for investors. Of course, 0 days to expiration options. There's no question 0DTEs are reshaping the broader market. But we're here today to separate fact from fiction, right? And who better to educate the Benzinga audience on this increasingly popular tactic than Cboe, the world's leading derivatives and securities exchange network. We want to thank Cboe for being terrific partners on today's webinar and for making it possible. So thank you so much to Cboe. And also for making available to us one of the world's leading authorities on today's topic. I'm speaking, of course, about Mandy, Vice President and Head of Derivatives Market Intelligence at Cboe. Mandy produces actionable insights and analysis on derivatives, market themes, and flows. Previously, she was Managing Director and Head of Equity Derivatives Strategy at Credit Suisse. Mandy is frequently cited in the financial media, including the Wall Street Journal, CNBC, Financial Times, Bloomberg News, and of course, right here at Benzinga. And so I'd like to invite Mandy to join me on stage now. Hi there, Mandy. Welcome.
Thanks, Matt. Great to be here. Thanks
great
for having
me. You. It's so great to see you. I've been looking forward to this webinar for many weeks now. So excited to have you on our stage. As I said at the top, the audience is indeed in for a treat. Now, before I turn things over to you, I want to point out to our viewers, you've been kind enough to agree to take some questions from the audience today. So our viewers can drop those questions into chat anytime throughout Mandy's presentation. And we will tackle as many of them as we can toward the end of the webinar. So listen, without further ado, Mandy, I want to get out of your way and welcome you to the stage. Thank you for joining us.
Thanks, Matt. And thank you, everyone, for joining us today. So as Matt alluded to earlier, 0DTE options have obviously been, one of the fastest growing segments of the derivatives market. But despite its popularity, I would say there's still a lot of myth and misconception, I would say, out there about the product, exactly what it is, who's trading it, what they're using it for, and ultimately, the market impact of 0DTE options have obviously come under scrutiny in recent months as well. So what I wanted to do today is spend, some time going over, exactly what are 0 day to expiry options, how are people trading it, what are some of the common strategies that we see, as well as look at, whether there are any truth to some of the allegations out there around the potential market impact of 0DTE option trading. So without further ado, let's get started. I wanted to start with this slide first, just kind of take a step back and really just talk about the boom in options trading that we have seen over the past couple years, really since the depth of the pandemic in 2020. And I would say it's really come in two stages, right? So what you see in this chart right here, in the gray, it's the equity and ETF option volume. So options on single stocks as well as options on ETFs. And then the blue is options on SPX, the index, right? So what you'll see is that really the first stage of the boom in options trading really happened in the latter part of 2020, beginning of 2021, and that was purely focused on single stock derivatives trading, right? So and I think the common term that everyone's familiar with at this point is the meme stock boom, right? So most of the option activity that we saw were on very small cap stocks, often highly shorted stocks, for example, AMC, GameStop. I think everyone's kind of familiar. And we saw, whole trading community really boom and grow out of, chat rooms on Discord or Reddit, Wall Street Bets. But, as you can see in the gray line, that has really kind of petered out or stabilized over the past 2 years. And instead, what we've really seen the boom in the past 18 months has been in index options, and particularly since we launched, daily expiry 0DTE option. So, starting in the middle of last year, going into now, you'll see SPX, option volume has kind of outpaced anything, all the um, uh, other underliers, and option volumes today are about more than 2 times in SPX what we saw in 2020, which was a record volatility year. Um, as you can see on the slide, we currently have 0DTE options on 6 underliers in really 2 index families. So the first obviously is the S&P 500 index family. So SPX is, probably the most well-known. It's the benchmark index. We also offer 0DTE options on XSP, which is the mini SPX. It's 1/10 of the size of the regular S&P index, as well as SPY, which is the ETF equivalent of XSP. In the second index family where you can find 0-day to expiry options currently is NASDAQ NDX, which is the benchmark index, XND, which is the mini NASDAQ, and QQQ, which is the ETF equivalent again of that. And right now, as of right now, there are no 0DTE options currently offered on single stocks. And I would say there are a couple characteristics, I would say, unique to index options that make it really conducive to 0DTE option trading. The fact that it is European style, meaning there is no early settlement risk. And then second, the fact that it is cash settled makes obviously the risk management of 0DTE options, a lot easier operationally compared to single stock options and ETF options, which are American style, physically settled. So being able to actually locate the shares, that's going to be a logistic hurdle, I think, kind of going forward. We'll see, what happens if that gets, resolved, if we see single stock 0DTE options. But right now, as of now, really it's focused on index options. And really, if you look at the notional volume that is being traded, SPX is the bulk of that. So I will focus the rest of my presentation today looking specifically at SPX 0DTE options. But I did want to start again, just on a broader level. And by pointing out there are 0DTE options currently available in other underliers as well. So if we turn to the next slide, this is really a breakdown of SPX option volume by expiry. And what you'll see in the bottom in the light blue, that is the share that is going to 0-day to expiry options. And you can see, the tremendous growth that we've seen over the past couple of years. I wanted to show this chart not just to illustrate the growth, but actually to dispel probably one of the most common misconceptions out there about 0-DTE options, which is that it's like a brand new contract or a brand new product that only started being traded, last year. That's incorrect. So 0-DTE option really refers to trading of an option on the day that it expires. So that means that any option at any given point in time, at some point in time, will become a 0-DTE option, right? So if you think back all the way to the 1970s when options were first launched on Cboe, we had at the time quarterly expirations, then moving into monthly expirations. That meant, 12 days a year, we'll have 0-DTE options trading. And as we kind of added more expiries, first with Friday weekly, then in 2016 with Mondays, Wednesdays, and last year is when we added Tuesday, Thursday. At that point, you had daily expiration options going out 5 weeks. That's when the 0-DTE trading phenomenon really took off. Not just because more expirations were added, but also because it opened up, I think, a whole new risk premium for investors to capitalize and to monetize. So one of the things that we have noticed with the 0-DTE trading over the past 2 years is that it's very different to how people traded options prior, right? So if you look at, at previous years, typically most of the activity in an option happens, way before it expires. When people create new positions, open new positions prior to expiry. And as you get closer to expiry, it's generally closing out of existing position. That's typically the volume that you really see on the day of expiration, people closing out existing positions and kind of rolling into new positions. But what we started to see over the past 18 months is that actually a lot of the trading activity was happening in an option on the day that it expired, meaning that people were opening new positions in an option on the same day that it expired. And you can kind of see that in the divergence between the volume data versus the open interest data, right? So the open interest data is only updated end of the day. So any new position that is created on the day that an option expires will actually not be captured in the open interest data. It will, however, be captured in the volume data. And that big divergence between volume and open interest that you can see in this chart, volume being in the gray and open interest in the green, that divergence really tells you people are opening new positions on the same day that an option expires. And there's a lot of trading activity that is happening on that last day of expiration. That is very different to what we saw in the years prior. I wanted to show this chart to address again, I would say another misconception out there. A lot of times when people talk about 0DT option volume, it's often expressed as a percentage of total volume, right? Which is kind of the chart that I showed a few slides back. And you see, growing from 5% to 10 to 20, and now between 40 to 50% of all SPX option volume is in options that expire the same day. So a lot of times when you see stats like that, people walk away with the impression that 0DTE options is taking market share or is taking volume and interest away from other expirations, right? People have somehow stopped trading longer dated options and everyone is trading shorter dated. And what you really see here is that volume is growing across all expiries. It's just that the rate of growth is fastest in 0DTE options. Or another way of saying is that the overall pie itself is growing, but 0DTE options obviously are taking a bigger slice of that pie. So I think investors typically trading 1 month, 3 months, 6 month, or even options going out 1 or 2 years. They're not replacing those strategies by trading 0DTE. Really 0DTE, I think, and I'll go into that in more detail later, it's opening up a whole new risk premium for investors to capitalize on. Another common question that we often get is, who really is trading these options? Is it retail? Is it institutional? Is it mostly speculative? Is it, for income, et cetera, et cetera? So this chart really is kind of our best attempt at kind of estimating the breakdown between institutional flow versus retail, small individual investors trading 0DTE options. And what I will say here is that this is just our estimate. We can see where the flow originates from, but we don't really see exactly who's the end client or the end customer that is trading. So about 90% of the flow in 0 day to expiry options originate from a retail brokerage firm, for example, Interactive Brokers, TD Ameritrade, Schwab, E-Trade, etc. But we also know, for example, a lot of institutional accounts use those retail brokerage platforms to execute their trades as well. So that in itself is not a true indication of the exact breakdown between institutional versus retail. So on our end, what we have done is looked at not just where the order originate from, but also the size of the order, the frequency of trading, how systematic is it, to kind of get a better approximation of how much of the flow is coming from, large institutional professional type of players versus, retail customers. And again, I would say one of the comment I would make about this is that the line is increasingly getting blurred between retail versus institutional or retail versus professional, in the sense that we're noticing, at least anecdotally, a lot of retail investors becoming a lot more systematic in their trading with, a lot of the advent of uh, automated trading platforms. So the line is definitely getting more blurry, but this is, again, our best attempt at breaking down that flow. And in our estimate, we think about 60% of the flow in 0DTE options are coming from what we call, institutional or professional customers. Those tend to be larger in size and more systematic, more higher frequency in terms of trading, versus about 40% that is coming from retail, individual small investors. And you can see, the share has stayed relatively stable, although in recent months, the institutional share certainly has gone up, a little marginally. And I would say that's, what we're seeing anecdotally on the institutional side is just wider adoption of 0DTE trading strategy. So that, we'll keep an eye on this going forward to see if it changes more meaningfully. But at least right now, about 60% of the flow is what we call institutional in 0 day to expiry options. Okay, so let's move on to this slide, which I think everyone wants to know, which is what are some of the use cases and how are people trading 0 DTE options? So I would say, broadly speaking, there are probably three main categories of use cases. The first is obviously around hedging. And I would say the kind of the introduction of daily expirations has meant that people are able to hedge, whether it's overnight risk, intraday risk, or event risk in a more precise manner. So you think about, hedging around, say, Fed meetings or, payroll data or CPI. So some of the macroeconomic data releases, now you can isolate that particular number, that particular event that you want to hedge for much easier with daily expiration options than prior to that, where you probably had to trade, a combination of, different expiries to really isolate that event risk. And we know from our institutional customers that a lot of them who are using these options to kind of hedge overnight or intraday risk in a much more efficient manner as well. The second broad category, and this is another very common use case for 0DTE options, is using it for income generation or yield harvesting. So typically selling these options for income. And whether you're doing in 0DTE or longer dated option, typically these trades, what they aim to capture is that volatility risk premium that is being embedded in options, right? So when you trade an option, you're trading the implied volatility of that option. And what you get is the kind of the realized volatility, what subsequently happens. And as we kind of, it's been well documented that implied volatility typically trades at a premium to realized volatility to compensate option sellers. So that spread, so-called volatility risk premium, is a lot of times what people aim to capture when they are selling these options. And what you'll see on the chart on this slide is that there is a very meaningfully positive volatility risk premium in 0 DTE options, with the premium being positive about 75% of the time over the past 18 months. So I think that explains why this continues to be a very popular strategy. People looking to harvest yield or income using 0 DTE options. And then third category, and this is when I talk about a new risk premium being opened up, namely intraday risk. I think that's a major component of the popularity of 0 DTE option trading, is now you can use these options to express a view on the intraday price action of the S&P, of the index, in a very capital efficient and limited risk way, right? So the embedded leverage, right? So if you think, the market's open down 1%, you think the market's going to rally back, buying a call option, right, where your risk is limited to the premium paid, and you're able to kind of make a bet on the direction of the market this way. I think that is a big part of the appeal, and I think part of the reason why we see a lot of single leg trades in 0 DTE options is to make that directional bet on where the market is going, whether you think it's going to continue with the way that it's going, or potentially reverse, right? So the momentum versus reversal, playing that on an intraday basis, is also another popular use of 0 DTE options. I wanted to talk a little bit about our VIX one-day index and kind of how you can use that to really tell you about what is being priced in 0 day to expiry options, right? So I think everyone hopefully is familiar with our benchmark VIX index, which is a measure of 30-day expected volatility of the S&P. So how much the S&P is expected to move over the next 30 days. Now, due to the rise of 0 DTE trading and a lot of the trading in ultra short dated maturities, we came out with VIX one-day index, VIX 1D index earlier this year to really capture the activity that was happening in the ultra short dated part of the curve. And what VIX 1D, one-day index, tells you is how much market's pricing in for about how much the S&P is expected to move in the next 24 hours. So it's, instead of 30 days, it's 24 hours. And if you look at the opening price of VIX one-day index at the beginning of of each day, that opening price is calculated entirely using options that expire that day. So that's a very good gauge of kind of how much options, the richness or cheapness of options that expire that same day. Now, as time goes on during the day, the index will start using both options that expire the same day as well as the next day to kind of interpolate that 24-hour, measure of expected volatility. But at least the opening print of each day is calculated purely using options that expire the same day. And what you can see on this chart over here is, which is looking at the index level, is that obviously the index level has come in recent months, kind of consistent with the overall volatility environment, right? Markets are much less volatile this year compared to last year. And if you look at the VIX one-day level compared to the option premiums of popular strategies, and here we're showing you in the blue the premium of if you were to buy an at the money straddle at the beginning of the day. So buying a at the money put and at the money call, the premium, the cost of that strategy is almost perfectly in sync with the level of the VIX one-day index, the opening print. Again, to my point, that opening print is calculated using options that expire the same day. So you can use that index to kind of give you a good sense of the premium, either if you're going long those options, how much it costs to put on a long option strategy, or if you're typically selling these options for yield, how much you can generate in terms of income. Okay, so let's can talk a little bit more or dig deeper into the trading profiles that we see and then of the popular strategy. So if I had to describe it, there are two adjectives I would use. The first is capped, and the second is balanced. So capped meaning that over 95% of the trades that we see in 0DTE options is is in capped risk format. So either people buying options outright where your risk is limited again to the premium paid, or in the cases of investors selling these options, they're typically doing it in spread format, again, where your loss is capped to the width of that spread, right? So about, and it's actually split pretty evenly 50-50 in terms of the single leg versus the spread. So either buying puts or calls outright, or selling call spreads, selling put spreads, or sometimes combinations of both, known as an iron condor. Those are by far the most popular strategies that we see in 0DTE options. Less than 5% of the flow is selling outright, naked calls or puts, where your potential loss could be, very significant or theoretically uncapped. So that, especially if we're thinking about potential risk in this space, the fact that very little of the activity is in uncapped or leveraged format, gives me comfort, at least in terms of the potential risks. If we do get a big market move, what the potential risks are to investors. And then the second, characteristic of the flow that we see is extremely balanced. So if we first look at, put versus call trading, what we notice for 0DT options, the put to call ratio has consistently hovered around 1. So equal numbers of puts and calls trading on any given day. And that is actually very unusual for index options. Primarily, historically, I would say investors have primarily used index options to hedge. They might have bullish views, or they might express individual views on, various single stocks, buy Tesla call, Apple call, etc. But when they need to hedge, they tend to gravitate toward index options. And that's why if you look at non-zero DTE expirations, there's typically almost a 2-to-1 ratio of puts to calls, many more puts trading versus calls, because primarily people use index options to hedge. We do not see that in 0DT. It is very, very balanced. 1-to-1. It has consistently been 1-to-1 through different market, environments as well. That to me tells me, again, if we think back to the previous slide on use cases, yes, a lot of people use 0DTE to more precisely hedge their risk, but that is not the dominant use case, or not the dominant community of investors using 0DTE, because if it were, you would see a much more skewed put to call ratio. And this, again, is very different from what we saw in single stock options in prior years. So I wanted to contrast kind of the retail activity that we're seeing, or the, general trading activity that we're seeing in SPX 0-day to expiry options versus what we saw, during the meme stock craze in 2020 and 2021. So what I'm showing on this slide here is the put call ratio for single stocks, right? And what you'll see is at the single stock level, there are typically many more calls that trade versus put. So the ratio is actually typically less than one. And what you'll see in that chart over here is that in 2021, the put call ratio got to basically the lowest since the tech bubble, meaning there were at that time about 2 to 3 calls that traded for every put, the highest kind of volume in calls since the tech bubble. That tells you at least the activity in options during 2020, 2021 was very much speculative, was very much one way, investors buying upside calls to position for further gains in a lot of the stocks. And obviously, when the market direction reversed in 2022 last year, a lot of the activity went away, as you kind of saw in the first chart, with single stock option volumes really kind of stagnating in recent years. To me, if you look at SPX's 0DTE volume, right, the fact that put call ratio hasn't changed, and also the share of the volume going to 0DTE really hasn't changed this year compared to last year, tells you it's not primarily speculating on the direction of the market. Because if it were, then you would see that ratio really start to change as the market, went down last year and then up this year. But you didn't. And the same with the share of the volume going to 0DTE has stayed very consistently between 40 to 50%. So to me, again, it means that the use cases, there's a diversity of use cases, not primarily one thing that people are using 0-day to expiry options for. And then the trading profile is very balanced. If we kind of do a deep dive in terms of the strategies, I'm going to start with the use case of kind of using these options for yield. I mentioned before the bulk of the activity that we see in income generating trades in 0DT are in cap spread format, which you can kind of see in this chart over here. Predominantly, people are selling these spreads to open, and in terms of the width of the spreads, the most popular, it's about 5 to 10 points wide. So very, very tight spreads. So meaning the risk is actually pretty minimal in terms of the potential loss. And typically these spreads are initiated, the short leg, very close to at the money, to where the market is currently trading. And they're typically done at the beginning of the day, right? So typically in the first hour of trading is typically when you see these spreads being sold to open by investors looking to generate yield or generate income using 0DTE options. Now, what we've also noticed is that oftentimes, even though the width is already very narrow, between 5 to 10 points, investors often set a stop to the short leg that's even tighter, usually between 2 to 3 times the initial premium. So there's actually very active risk management going on with these strategies. I think people are aware, when you're selling options, right, to either do it in tight spreads or with a tight stop to kind of manage the risk if the trade goes against you. And that's indeed what we're seeing in terms of popular trading strategies and popular spread width. If we look at the single leg of volume, so this is, either buying calls, trading calls or puts outright, most majority of the volume that we see is people either buying it to open, which is in the top chart, or selling it to close. Like I mentioned, less than 5% of the 0DTE volume is in actually naked selling of puts or calls. So selling to open, that green bar in the second chart, that is a very minimal part of the 0DTE volume. And another thing that we have noticed is that the single leg strategies and activity is often tied to the spreads that I showed in the previous slide, right? I mentioned people kind of set very tight stop limits to their short leg. So as those legs get stopped out, people will start repositioning via single legs, kind of trading around their spreads. So that's something that we've often noticed as well. So I do think the volume between the single leg versus the spreads are connected oftentimes, or there are a lot of popular strategies around repositioning your spreads throughout the day as the market moves around. Okay, so for the last part of the presentation, I wanted to specifically address some of the concerns that have been brought up by commentators around, the potential risk to these products, right? And a lot of times when they talk about risks, people often point to the high volume that is going through these products, right? So, 40 to 50% of overall SPX volume. If you look at notional volume, we're talking about 500 billion a day in notional volume being traded in SPX 0DTE options. Big, scary numbers. But the point I wanted to make here is that high volume doesn't necessarily mean high risk. It really matters what the breakdown in that volume is, right? And if you take a very simplistic case where 100,000 contracts trade, if 50,000 contracts was customers buying and 50,000 contracts was customers selling, then despite the high gross volume, there's actually there's net zero risk for market makers to hedge on the back of that volume because the risk is evenly balanced between buys versus sells. And what you'll see in this chart, this is an example that we took from August 15th. That was a day when there was a lot of 0DTE headlines in the news from commentators suggesting that 0DTE trading was kind of what was driving the S&P on that day. If you actually look at the option positioning on that day, what you'll notice is that it's actually very evenly split between buys versus sells. Here, I'm looking at market maker positioning, but customer positioning would be really the other side of it. What you'll see is, across different strikes, for example, on that day, the 44.40 strike kind of was what everyone was focused on. Yes, over 100,000 contracts traded, but it was very evenly balanced between buys versus sells. And because of that, because it's evenly balanced, what we're able to calculate is at any given point in time what the net market maker exposure is. And this is, a little bit of a complex chart. And I'll, kind of quickly go over, the main takeaways. What we're showing on this chart is market maker net positioning at different points of the day over the past 18 months. And this is a box plot and a couple of important informations from this box plot, right? So the first is the kind of the bar in the middle, which shows you the average. So the average net market maker positioning throughout the course of the day hovers between 100 to 600 million over the course of the day, right? That's what we calculate it to be. To put that number in context, right? S&P futures trade about 400 plus billion a day. So we're talking about net market maker positioning or their hedging flow. That's less than 0.1% of the S&P daily volume, right? So again, it's not significant, and it's not significant because the flow is so balanced. If you look at the whiskers on the box plot, right, the min and the max, that kind of tells you how extreme it can get over the course of the year. And as you can see, that range certainly grows as you get closer to expiration, closer to the end of the day. But even then, we're talking a couple of billion in swings in the market maker exposure. In the context of, again, the S&P market, that's 400 plus billion in terms of average daily volume. It's not a significant driver of the market. Another point that we wanted to make here is that market makers oftentimes, when they're hedging 0DTE options, are not necessarily their first choice isn't really to hedge in the underlying with futures, right? They could hedge with other 0DTE options. They can hedge with other underliers. So, positions in SPX with positions in SPY or XSP or E-mini futures. So there are actually many things market makers can do that do not result in trading of the underlying. So overall, what we find is that the net positioning for market makers in terms of how much they have to buy or sell in the underlying S&P to hedge their 0DTE position to be fairly de minimis relative to the volume of the market. And another way that you can kind of tell that the market impact is fairly minimal is the fact that we have not seen a significant pickup in intraday volatility of the S&P index, right? So if 0DTE option trading is causing distortions in the underlying market, we would expect to see more intraday volatility in the S&P index itself compared to close to close volatility, which is what the second chart shows. And what you'll see is that this year, intraday volatility relative to close volatility is really right in line with the 10-year average, meaning we're not seeing meaningful differences in intraday price patterns in the S&P this year compared to the prior 10 years when, 0 DTE trading was not as popular. And the second chart on this on the slide shows you the frequency of gap moves in the market, and we define gap moves by looking at 1 minute returns in the S&P, comparing it to the previous 30-day minute volatility. So basically, if the market was kind of grinding along and suddenly drops, right, suddenly gaps up or down, that potentially could be because of outsized hedging needs from market makers. So if we were to see more higher frequency of gap moves in the market, that could potentially be a sign that market maker hedging is having a disproportionate impact on the market. But what we find, and again, you'll see in the slide, is that there's really been no notable pickup in either gap moves during the entire course of the day, or even if we just focus on the last hour going into the end of the day when market maker hedging is typically most pronounced, we're not seeing any pickup in potential kind of gappy moves in the market. So that kind of gives us comfort, along with our market maker positioning analysis, that 0 DTE option trading really is balanced. And because it is balanced, market impact overall is fairly minimal. So with that, I'm going to end it here. We're happy to take questions. I have put on the slide, some existing reports that we have published around this topic. So the first one that you see on the left, the rise of SPX and 0 DTE options, is a very comprehensive, fantastic white paper that my colleague put out. We have a QR code that you can scan to get access to the white paper. In the middle is the piece that I wrote on kind of evaluating the market impact of SPX 0 DTE options. So a lot of what I spoke about in more detail, you'll be able to find the full report here as well. And then to the right, the last one is a blog article that we have on our website on the evolution of same-day options trading, kind of going through the history of 0 DTE trading and the various, the strategies that I've discussed. So with that, I'm going to turn it over to Matt. I think we're, happy to take questions, but hopefully this is a, concise view and a concise overview of the 0 DTE phenomenon.
It has been indeed, Mandy. Great job. And I'd love to leave that screen up just for a moment for
Yeah.
folks to download those resources. They're terrific resources. The last 40 minutes, I'm sure, was just a preview of the incredible amount of analysis and insights that Mandy and Cboe have. So I would urge folks to check out those resources. Mandy, terrific job. We've got a number of questions I'd like to get to. And I think I'd like to start here. I think this is an opportunity to sort of sum up a lot of what you talked about, certainly for anybody who may have joined us late. Talk to us about why, in your mind, there are so many different opinions on the market impact of 0
Yes.
DTEs, right? And then part two, why is your view any different than those external views?
Yeah, sure. Yeah, you probably have seen in the news headlines, a variety and diverse range of opinions on kind of the market impact of 0 DTE options. And the reason for that is that about 98% of the options of 0 DTE options trade electronically, right? So there's actually very little visibility the most
Mhm.
outside third-party observers have on the flow, on the makeup of the flows, right? So it's very different from someone calling up a bank when the bank having know who the end customer is, exactly what they're trading, because everything is kind of going through the pipes. There's very little visibility, except for if you're the exchange, that's actually where all this option activity is happening, and that's why we've tried to provide clarity and publish so many pieces on 0 DTE trading, is because at the exchange we see the flow, right? We see for every transaction in 0 DTE SPX options, who's behind it. Is a customer, is a market maker, is a firm, is it buy, is it to sell, is it opening, is it closing? It's a level of detail that other outside observers don't get. So I think that's why that's why I think you get such a diverse range. It's because people don't have the clarity. They make assumptions. They assume X% of the flow must be retail, X% of the flow must be buying or selling, but they don't know. But at the exchange, we do, and that's why we're, that I think that's why our analysis is very different from other people's, is because we actually can see the flow and provide insights based on what we see.
That makes a lot of sense. Mandy, you touched on this next question toward the end of the presentation quite a bit, but I still think it's worth asking. How much credence, you lend to the idea that 0 DTE trading could lead to another Volmageddon type of market event.
Yeah, that's a common concern that people have. And so to kind of refresh, or to maybe for those who don't know, Volmageddon was what happened in February of 2018 when several VIX ETPs basically collapse because of a spike in volatility. And really what happened there was in 2017, which was a record low volatility year, a lot of the inverse VIX ETPs, right? So basically the ETPs gain in value as volatility declined. They started building more and more leverage. The more volatility remained muted, the more leverage they built over the course of a year, so that in February of 2018, when we did get a volatility spike, those ETPs had to deleverage very, very quickly and very abruptly. Now, what's different about 0DTE trading? Two things. One is that the risks do not build over time, right? By definition, they expire at the end of the day. You start each day with a clean slate. So this is not going to be a case where you have an extended period of low volatility. People are going to be building outsized positions, and suddenly you get a vol shock and and get a big market moving event like that. And the second, and that's something that I went over, I think, in quite a bit of detail, is that a lot of these short volatility trades that we're seeing in 0DTE options, so people selling options, are doing so in capped formats, oftentimes very, very tight spreads, right? So the risk is actually very minimal in that sense, relative to, say someone selling a naked call or naked put, where, yeah, if the market goes against you, you can have potentially very large losses. But if you're doing so in capped format, your risk is limited from the outset of the trade. And then also, in addition to the capped format, we also do see people even set tighter stops to their trade. So very, I think, active and dynamic risk management that has been going on in the 0DTE space, that to me sets it apart kind of from what we saw in 2017 in the lead up to 2018, when kind of volatility spiked and on the back of the VIX ETPs.
So, Mandy, you talked about how 0DTEs are not an especially new product, right? But obviously they're booming in popularity. Do you guys anticipate similar rates of growth, acceleration in the popularity of this product in over the next couple of years, or are we sort of going to reach kind of a crescendo at this point?
Yeah, no, that's a good question. And I honestly, I think only time will tell. What I can say is that we're still seeing new players or new entrants into the space. So I alluded a little bit to this earlier when we talk about institutional adoption is growing, right? So I think a lot of time retail tends to be the first movers, right? They're a little bit more dynamic. A lot of institutional investors, they want to see the data, they want to make sure the market is liquid, they want to make sure they have enough historical data to back test their strategy. So they tend to actually be slower moving. So what we're seeing this year is, as more and more institutional investors get comfortable with the liquidity of 0DTE options, with the diversity of use cases, when they get access to data, they're able to back test strategies. We're seeing actually wider and wider adoption there. So I do think there's probably still some runway left to go, but whether 0DT ends up being 50, 60, 70% of SPX volume, that I don't have a high conviction in where it will max out at. But I do think the volume and the trend is here to stay, and it is it's been sustained, and it's been sustained through different market cycles and different volatility regimes, right? We're seeing 0DTE trading consistently 40 to 50% of SPX volume, whether the market is up or down, whether VIX is in the 20s, in the 30s, or in the teens.
So we're getting some questions about some of the differences between 0DTEs and other short-term trading instruments. So can you talk specifically about the pricing and premium of 0DTEs compared to longer expiration periods?
Yeah, that's a great question. So, 0DT options make up about 40 to 50% of volume. But if you look at actually the premium people spend in SPX options, 0DTE is, I think, around 7 to 9% of the total volume. And that's just a function of, again, being ultra short dated. The time premium that is being embedded in these options is, it's a fraction, right, of what it is in for longer dated. So the absolute cost of 0DT options tend to be very low. And that's, again, to the point about diversity of use cases, is 0DT option rich or cheap? you can make an argument both way, right? It is rich in the sense that there's a very substantial volatility risk premium that's being embedded into these options, but it's also quote unquote cheap in the sense that the absolute premium that you're paying is much, much lower compared to longer dated options. And I think, for people who are making directional bets on the market, that low absolute premium is what draws them to the space. And for people who are selling these options to collect the yield, and to play the volatility risk premium, the high embedded risk premium is what draws them in. So that's why you get kind of both sides, and that balanced user base and the diversity of use cases.
So, Mandy, I think I want to close here. And this is maybe a tough one for you, but I'm going to throw it to you anyway because you're a pro. How can traders leverage news and events on a day-to-day basis to make more informed decisions when they're trading 0DTE's?
So if you go back actually to the chart that I showed at the earlier around, yeah, VIX 1 day. So I
Mhm.
do think this is a really good tool if you're actively trading 0 DTE options to look at, because you'll notice on these index, and hopefully you can kind of see where my cursor is, there are definitely spikes, very notable spikes in this index. And if you line it up with events, these were happening around either Fed days or CPI days. So people would definitely gravitate towards 0 DT options on these macro catalyst days, right? So if you have a view around, what's going to happen for a Fed meeting or a payroll, there is substantial risk premium that are being embedded in 0 DTE options on those days, as a result. But certainly looking at, using, indices such as the VIX 1 day can kind of help you navigate, what is being priced into 0 day options. I think that is a really good tool to have.
For sure, no question. Well, listen, Mandy, this has been terrific. I can't thank you enough for the wealth of information that you've shared with our audience today. Just really great stuff. We thank you so much.
Thank you for having me. It's a pleasure.
It's our pleasure, and we're going to do it again, Mandy. Thank you so much, and on behalf of the entire team here at Benzinga and to all of our viewers, we greatly appreciate the great Mandy Zhu for coming out and sharing her insights and her analysis with us. Thank you also, of course, to our partners at Cboe, the world's leading derivatives and securities exchange network. Certainly a terrific partner to us at Benzinga. So thank you goes out to our friends at Cboe. And finally, a big thank you to all of you for taking time out of your busy schedules to join us today. We hope you enjoyed the event. Be sure to check back with us in 2 weeks. We host a live webinar every other Thursday. And of course, you can view our upcoming events, including the two big live events in New York next week. Check them out and more at benzinga.com/events. For everybody here at Benzinga, I'm Matt Steinmetz. Thanks for joining us. We look forward to seeing you at another event very soon.